Hi everyone and welcome to Swissquote's Daily Market Talk. We are the first day of May. Geopolitics remain ugly with no resolution in sight for tensions around the Strait of Hormuz, keeping oil supply tight and volatility elevated. Central banks are holding their rates steady, but the divergence in tone is quite striking, particularly at the ECB that discussed about hiking the interest rates this month. But equities remain resilient, strong earnings notably in banking, energy, and also AI-related names are offsetting macro concerns, and that AI-driven optimism continues to push US indices to record high levels. In summary, the market rally continues despite the unideal geopolitical and macroeconomic backdrop into the month of May, which is actually known as being a seasonally weak month. So we will talk about what to expect in the month of May and more, but before we do, and as always, please keep in mind that opinions are my own and this is not financial advice.
This show is brought to you by Swissquote.
So another month ended with no light at the end of the tunnel for the Iran war. On the contrary, the US is not willing to lift the naval blockade in the Strait of Hormuz, while Iran said that it will not give up its nuclear program and will not come to the negotiation table if the US doesn't lift that blockade. I mean, we are repeating the same sentences every day. Meanwhile, the near closure of the Strait of Hormuz keeps the oil market around the world quite tight. Donald Trump downplayed yesterday the rising oil prices as there is plenty of oil in the market. In the Strait of Hormuz blocked there, he said that oil prices will come down like a rock when the issues are resolved. But when will the issues be resolved? That no one knows. And this was the expected conclusion of the various central bank meetings this week. The Federal Reserve, the Bank of Canada, the European Central Bank, and the Bank of England, all of these central banks left their rates unchanged this week, but the accompanying statements were more aggressive for ones than the others. In this context, the European Central Bank, for example, left the interest rates unchanged at yesterday's announcement, which first resonated as being quite dovish decision across the markets until Christine Lagarde took the stage and told everyone that the possibility of a rate hike this month was actually discussed at this week's meeting and that the action could eventually come as soon as June, depending on the economic data. But that's the issue, right? The data announced earlier to the ECB decision yesterday confirmed that the energy crisis slowed growth in Europe to almost none in the first quarter of this year, while pushing inflation to 3%. So at some point, the ECB must step in to tame inflationary pressures by destroying demand or growth, but also knowing that destroying demand in Europe won't open the Strait of Hormuz and won't pull energy prices notably lower. So it's a tight rope to walk. In finesse will come down to whether the actual inflationary pressures will reflect in salaries and broader prices. That's going to be determinant for the ECB on whether they will go ahead with a rate hike in June and more for the remainder of this year or not. The same applies to the other central banks, of course, as well. Now, what's clear is that the ECB's hawkish stance, though, brought the Eurobulls in yesterday after Christine Lagarde's press conference. The Eurodollar extended its recovery above the 100-day moving average, but a benchmark 10-year yield for the Euro area bonds fell sharply as the STOXX 600 jumped 1.38% after a sharp rally in oil prices was followed by a sharp downside correction. And because there was no clear trigger for that correction, I believe that the sharp move that we saw in oil prices to the downside yesterday was a reaction to the preceding rally to the levels that actually do trigger the narrative of demand destruction. Indeed, the market reaction since the start of this war suggests that the market shifts to that demand destruction narrative as soon as we approach and breach the $120 per barrel level. Now, of course, this is not a line in the sand. A prolonged conflict in the Middle East could eventually break the back of the $120 per barrel offers, but yesterday, the sharp retreat in oil prices certainly helped boosting appetite in equity markets along with earnings, of course. On that front, the strong earnings, especially from banks and energy players, clearly boosted appetite in STOXX 600s, parallel to what's happening across the Atlantic Ocean, because over there, major US indices hit fresh record high levels yesterday thanks to the AI boosted rally. The Dow Jones, on the other hand, also gained 1.62%. It is still a little bit lower than its all-time high level, but Caterpillar, for example, the world's biggest construction equipment maker, crushed estimates with a 22% rise in its first quarter revenue thanks to the massive data center demand and electricity infrastructure needed to power them up. The company's CEO said that the company accumulated a record backlog of orders. He was talking about 63 billion US dollars orders, up nearly 80% since last year, suggesting that the AI boom is stealing jobs from many white-collar workers, but is creating jobs elsewhere, especially in construction. And some predict that the AI spending will hit the 1 trillion US dollar mark next year, which wouldn't be surprising as after the latest earnings update, the big technology alone is now expected to spend past 700 billion US dollars this year. That could also be revised up to 800 to 900 billion US dollars as we move on this year if you ask Overcore and Bank of America analysts. So this AI boom is spilling beyond the technology and the AI models. They are spilling into construction names, and there are going to be plenty of jobs on that front. Let's watch. So we're entering the month of May, which seasonally tends to be a slow month. They say sell in May and go away, right? But we're entering this month with resilience of the corporate earnings outweighing the war headlines and the inflation-related worries. Data released yesterday in the US warned that the US economic growth may have slowed to 2% in the first quarter of this year, but price pressures unexpectedly ease as well. And the letter pulled the US 2-year yields that captures the Fed rate expectations lower as the US 10-year yield slipped below the 4.40% mark. US futures are hinting at a positive start today, while many European markets here will be closed due to the Labor Day holiday. I believe that the AI optimism will be the base case for the day before the weekend unless things get ugly on the geopolitical front. But if we don't see any major news, I think that we could see another record high in the S&P 500, Nasdaq 100 before we close this week. Because yesterday after the bell, Apple announced its latest earnings and the results were actually better than expected as revenue from their subscription services reached almost 31 billion US dollars. The company also authorized 100 billion US dollar worth of stock buyback and increases dividends by 4%, which is kind of great when inflation expectations are rising. And the latter could give an additional boost to the AI and technology complex today. But in the particular case of Apple, the company is nowhere to be found in the AI race, really. It relies on others' models instead. From a spending perspective, that's great because they don't have to spend on pricey infrastructure. But from a strategic perspective, the fact that they are not building their models increases their reliance to model providers like Gemini or OpenAI, which means that margin pressure and reduced control over its ecosystem over time will be building up, leaving Apple more exposed to the pricing power and innovation cycles dictated by external AI providers rather than its own decisions. So I'm not really convinced that Apple is the best play here either. In the FX, the US dollar eased yesterday, pulled sharply lower by a swift sell-off in the dollar-yen after the Japanese authorities stepped in and warned that they would intervene to halt the yen's depreciation after the pair traded past the 160 level. Surprise! Well, that was an easy trade, I guess, for those who knew that that would happen. Because there is indeed a very clear pattern today. When the dollar-yen approaches or trades above the 160 level, the Japanese authorities expressed their concerns. They warned that they will intervene, and maybe they also do intervene. Now, of course, the FX intervention itself is not enough to reverse the yen's depreciation, but it does clear the speculative bearish positions and give relief for a while. And for traders, while buying Japanese yen may not be convincing in the medium run, but selling the dollar yen into the 160 level, if done timely, could actually result in quick gains. So this is all for this week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week, and until then, good day trading and have a lovely weekend.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.